Welcome to the Workplace Minute, powered by H3HR Advisors and sponsored by Paychex, one of the leading providers of HR, payroll, retirement, and software solutions for businesses of all sizes. My name is Steve Boese. U.S. corporate profits soar along with dividend payouts and stock repurchases. United States headquartered corporations are making more money than ever before, and they're allocating much of that money right back to shareholders. One of the reasons the S&P 500 equity index has risen more than 10% so far this year is because investors anticipate dividends, the redistribution of profits from a company to its shareholders, to grow even larger. Dividend payouts to shareholders by companies in the S&P 500 reached a new record in 2023, and that number is projected to grow in 2024, according to data from the CME Group. The data showed that the 200 largest publicly traded companies in the United States saw their combined net profits soar to $1.25 trillion in 2022, a gain of 63% from 2018. About 90%, or $1.1 trillion of that profit, went to shareholders through stock repurchases, sometimes called buybacks, and to shareholder dividend payments, according to new research from anti-poverty organization Oxfam International. At the same time, the study found only 10 of those 200 companies have made public statements in support of paying a living wage to their employees. In contrast, CEO pay, often bolstered by company stock price appreciation, has soared by nearly a third for those companies since 2018, according to Oxfam. For some of those companies, the average CEO to worker pay ratio is now above 1,500 to 1, the nonprofit organization found. Critics of buybacks say they allow highly compensated executives to manipulate markets while directing corporate profits back to themselves and other wealthy shareholders instead of going back to workers. Preventing or restricting share repurchases, they argue, would free corporate cash to invest more in growth and raise employee wages. But corporations counter that they use stock repurchases to efficiently distribute excess capital. Limiting buybacks, say supporters, could reduce liquidity in stock markets and eventually hurt share prices. Executives typically use buybacks to reduce the number of shares in the market, thus increasing demand for the stock and the earnings per share. Oxfam, in a report compiled using publicly available data, argued that the largest U.S. firms have also reinforced gender and racial inequality in the workplace by prioritizing buybacks and dividend raises over their employees' well-being. If the 2024 trend continues and U.S. corporations continue to see record profits and increasing share prices, it will be interesting to see if and when more of these organizations look to increase their investments in employee compensation, benefits, and well-being. Organizations enjoying high profits today should look to allocate resources into investments that will help them in the long run, and investments in employees are certainly chief among their options. We will continue to monitor and report on this important topic and how organizations decide to invest here on the HR Happy Hour Media Network. That's it for the Workplace Minute, powered by H3HR Advisors.